All right, so you're sick of your existing home right now, or you're expanding on the seams, or you're looking to add another piece of real estate to your portfolio while keeping the existing one that you own right now. Move-up buyers are often neglected in the marketplace, and we often don't talk about them enough. We're usually talking about investors, first-time buyers, or other people. And the reality is the vast majority of people at some point in their home ownership journey move up. They end up selling what they have and making a move up to another property, or they end up keeping their existing home, which is another option, and purchasing another property. And this is going to be a definitive explanation of what you need to know about making that move up and what you need to consider when you're doing so. Okay, and wait to the end of the video because I'm going to explain to you some things that people really screw up on and how to avoid them. Plus, we're going to talk obviously about that keeping your property and other things that you can consider. What's up, everybody? Thanks for coming back to the channel. Alex McFadyen here. Hit that subscribe button and say hi to Chewy. He's always hanging out with us here. Let's get into the breakdown of the move-up buyer, what you need to know, how to use your equity, some considerations and costs, and really, if you want to keep your home, what that could look like. Let's get into it. First step of being a move-up buyer is you need to understand what you have and where you are, which means you need to have a clear understanding of equity and how it works and how it impacts you when it comes to your home and your move up. Right off the bat, equity is the difference between what your home is valued at today, so what are you going to sell your property for, and how much money that you owe in debt on your existing property. Now, if you have a home equity line of credit and you owe money on that, let's say $100,000, and you have a $400,000 mortgage, means you actually owe 500 grand. If your home could sell today for $800,000, then you have $300,000 of equity. But that is not how much money that you can use for that move up. For that, we're going to dig into it a little bit later in this video. Now, the reason we mentioned the home equity line of credit is because a home equity line of credit could be a very useful tool if you are thinking about making that upsize. And this is for the purpose of a deposit or potentially keeping your existing property for a down payment. Now, we use a $300,000 number because the average Canadian, according to CMHC statistics, has $300,000 of equity in their home at this time right now. Now that you understand what equity is, we need to understand a few things. First and foremost, the expenses in selling your property and the real amount of equity that you have and the impact on your financing when it comes to your future properties. For example, have a look at the summary of a sell to buy scenario. An $800,000 property, if you're selling and paying off a $500,000 worth of mortgage and a home equity line of credit, you might think you have $300,000 as a down payment on that property that you're purchasing. But hold on, that's not quite the case because we have a few things to consider. Number one, well, you've got to pay somebody to sell your house. Now, a lot of people say, I'm not paying a realtor. The reality is that virtually everyone that sells their home ends up paying expenses to sell. And most frequently, if you're using a real estate agent, you actually pay commissions. So we factor in the commission expenses. Number two, we're going to factor in the second one that almost no one thinks about when they actually get their mortgage, which is the prepayment penalty. And this is something that we talk about a lot when it comes to qualification and picking your lenders. So to get your prepayment penalty and understand your costs, you need to request a direct quote from your lender for a prepayment penalty. You don't have to say you're selling your house or anything. You just want to let them know that you would like to know the breakage fee for paying off your existing mortgage. Remember, that prepayment penalty can change daily, but you need to know what that number is. Number three, you're going to have miscellaneous expenses such as a discharge. You're also going to be looking at expenses like legal fees and potentially other expenses depending on if there's any other debts you have to pay out, which leads me to the next point. Often when people are selling their property, they have equity. Let's say we brought it from $300,000 and down. They might have a car loan or another debt which will impact their ability to qualify for the next home, or maybe it's just at a high interest expense and you'd like to consolidate that. This is the time at which most people will consider paying out any unnecessary or debts that are hanging around and actually consolidating those into the future property. The way that you do that is you essentially pay them off from the proceeds and you indicate for your mortgage broker that you're going to do that, at which point the lawyer will take care of ordering statements and taking that out of the equity. Now let's make the assumption that after making all of these payments, the commission, etc., all that's paid out, you're now left with $225,000. That is the amount of equity that you have now to purchase an upcoming property that you're looking at. So we know how much money we need to qualify for. This will help us to indicate specifically what you could do when it comes to the qualification on the purchase side. There's so many things to consider. First and foremost, what does your income qualify you for? As you may know, you qualify for less if you're doing a CMHC mortgage versus a conventional uninsured mortgage. Now, if you have 20% down on a property, you will qualify for about 15% or more than a CMHC insured mortgage application. So that's where indicating what price point that you're trying to get up to will be impactful. Now, the only way to really figure that out is to get a proper qualification done with your mortgage professional. But if you're looking for a quick way to get a general estimate, you can use a pre-qualification calculator that we have available. Download the app that's in the link in the bio to get a general idea. Although we do not recommend going very far with that information because there's so many other numbers to figure out. Now, once we've determined we've got $225,000, let's say this borrower is looking for a home upwards of $1 million, and let's say that we're blocked with that being the money. We have no extra savings and nothing else to put towards a property. That $200,000 will form the down payment on the future property, and we're going to have to factor in closing costs. Now, depending on which province that you're in, some provinces have land transfer tax, Ontario and British Columbia, and others do not, such as Alberta, and of course there are other provinces to consider as well. So you want to make sure to check in your province if there's any land transfer taxes. Now let's use BC as the primary example because that's where most of our clients are located at this time. BC has a transfer tax of 1% of the first $200,000 and 2% of the amount above that. So at $1 million price point, you're paying $18,000 in transfer taxes. In addition to that, you might be paying appraisals, home inspections, legal fees, and let's not forget home moving costs if you need a mover or anything else that comes up. And so having $25,000 would be probably the minimum recommended amount of money to be able to make that transition. So if you're making that sale and move up, you would have in this case 20% down payment, $200,000, which gives you the ability to qualify conventionally, avoiding insurance, and making the transition. Okay, so now here's some things that almost nobody thinks about when it comes to making this move up. Really, really important stuff. Number one, the deposit. This is massive. When you're making a move and you're purchasing a property and you're selling your property, there's so many circumstances where your money is tied up in investments or you might not have any savings that are readily available. Well, a lot of people think, well, I just have equity in my home. I'll just go ahead and place my deposit through there. Well, you have to actually get access to the deposit. So remember, if you're buying a property and selling a property, you need to make that deposit. If you do not have access to the cash through a line of credit, a credit card, or savings, or a gift, then there is something called a deposit loan. And this loan will allow you to borrow money against your property and it'll get paid out at the completion of the sale of your home. There is an expense associated with that, and you need to make sure that you've sold your home before you can place another offer on another property. That's mistake number one. Number two is just genuinely qualifications. One of the biggest mistakes that I see people make all the time is they don't actually get a proper pre-approval. They go talk to their bank and they say, hey, can I port my mortgage? And the bank says, yes, you can. Well, yeah, you can qualify to port your mortgage, but can you port your mortgage for this exact circumstance and scenario? And the reality is, most frequently the answer is no. You can't, or maybe you need to actually adjust it to be able to access the equity you're looking for, or maybe you need to pay out some other debts, or maybe there's a better option there for you. And so the number one issue I see from people is they don't get properly pre-approved with a full detailed analysis and breakdown of the expenses that I just shared with you, which is what your mortgage broker should be doing if you're making that move. That's issue number two. Number three for move-up buyers is not accounting for additional expenses and items like we talked about earlier, which include the cost of sale, the cost of purchase, maybe taxes if you're selling an investment property, or other things like that. And so we highly recommend doing a full and proper analysis if you're making that move up buy. We don't want to make it sound more complicated, but you got to protect yourself because you're selling your home and making that move at this point right now. What are the things that you have to look for if you want to keep your home as a rental property? Now, there's a lot of people who believe that I just couldn't keep my home, and so they're going to sell their property and move on. But if they had the opportunity to keep their existing property, they might actually do so. Now, here's a few things that you need to know. Number one, if you're thinking about keeping your existing property, some of the advantages obviously are depending on that home's situation, the potential of additional cash flow, the potential of getting equity out of that property, the long-term value if that home is in an area where maybe it could be redeveloped, or maybe you keep it for a family member or your kid for the future. There's so many different advantages of keeping your existing property. You've already bought it, so you don't have to add any additional expenses to doing so. Now, if you're looking to keep your existing property, one of the biggest things is actually the payment and the equity. Let's say, for example, you have that $800,000 home, but you only carry a mortgage of, let's say, $400,000. Well, you could technically borrow up to 80% of that 800 grand, which gives you access to another $240,000 out of that property. And if your move up is $1 million, then you have enough to make it work. Now, how you do that is subjective. One way is you can refinance your current property, pull out the equity, and that's money that can be used for the purchase of a home. Hot tip there, the refinance should be complete before you go ahead and make any purchases on it or any offers on any of the properties. Number two way that you can do that is you can add a home equity line of credit to your current mortgage or refinance to add a line of credit. a home equity line of credit can be used for the purposes of a down payment on another property. There's pros and cons to both options from both a monthly payment standpoint and an interest standpoint. On a mortgage, you're paying principal and interest and the rates will be lower, but on a HELOC, you can pay it off at any time and it's interest-only payment. So there's pros and cons to having both options available if you're looking to make that change. Now, the other cons to look out for is while you're managing a property now. So if you didn't want to have a rental property, well, you will now. So there's something to look out for. We suggest considering a property manager when evaluating your numbers, which leads me to my next point is when you are making that change, one of the biggest reasons that people don't do that is because they don't have their property rented out yet and they're concerned that they can't use rental income. While not every lender will do this, a lot of lenders will give you the ability to actually utilize what your property will rent for from an appraiser when it comes to your rental income. So that will assist you in your qualification. Now, in some circumstances, the debt ratios just don't work. Like you don't make enough income or there's not enough income there, or the property that you're trying to buy, the monthly payment would be too high and your expenses would be too high as a result of that. But given the opportunity, this is one of the best ways to continue to keep your properties and continue to build your net worth and your portfolio if you are someone thinking of owning a property as a rental. Now, you should definitely talk to someone who understands the marketplace, not just your mom or dad, perhaps maybe a mortgage professional like myself or a real estate agent who understands investing in the area that you're looking at, who's willing to analyze the pros and cons of that opportunity for you. But objectively speaking, again, I've done this now 5 times and it is a great opportunity for you to be able to make that transition if you can qualify and keep your portfolio. Typically what I found is that there's going to be a sacrifice made, meaning you're not going to be able to purchase at as high as a number as you might have otherwise, or you'll have to make a sacrifice at some point in terms of how much your monthly payments are. But again, this comes down to your goals and what you're trying to do. So let's just talk on a few key other strategies that you need to be thinking about real quickly here. Number 1, bridge financing. If you're making that move and you're selling your property and moving up, as long as you have a mortgage on the property that you're purchasing, you can bridge the money from your sale if the dates don't line up. Typically that means is the dates for the sale don't match up with the dates of the purchase, meaning you need to close on your purchase before you sell your other property. There's available options for bridge financing, but they're different with every lender. So you need to be conscious of that. And there's costs associated with that. You have to pay for that money daily as you move forward. The other thing to look out for is what we talked about earlier. Sometimes when you're moving, you have the ability to port your mortgage. And if you're still in a low rate loan and it makes sense, then this is an option that you should consider. But you should definitely get the details from the source and then analyze that based on other options before making that conscious decision. And the last but least thing here is you should definitely have a clear understanding of the marketplace. One of the biggest mistakes people make, and I see this happen all the time in a changing market, is they sell before buying or they buy before selling with no understanding of where the market is and what their bottom dollar is. Listen, if you're gonna buy your house before you sell your house and the market changes, you need to know what your bottom dollar is so that you can get rid of that property and still be able to make that transition. Making the decision on that can be tough and you need to lean on experts who are involved in the industry to make a conscious decision as to what you're willing to do or not do. Don't let that scare you. You just need the facts. You need the information to make an educated decision. And remember this, what the property was worth 1 month ago, 2 months ago, 6 months ago in these markets in the last 10 years is irrelevant. What a market's worth is what someone's willing to pay for it or sell it for in any given time for their situation and scenario. So in summary, there's a few key things you need to do. Number 1, know your financial situation. Understand there's more than one different lending option available to you so you can qualify differently. And then number 3, be prepared and understand the facts and the data. As long as you know this information, then you can have success in a move up situation. We can go on forever, but if you found this information helpful, go ahead and hit that like button, hit the subscribe button below. And if you'd like a consultation or a thorough breakdown, send me a message, contact details below.